Breakout strategies. One of the most exciting moments in trading. You draw your support and resistance levels and wait for that explosive move when the price suddenly punches through. And when it does, it often moves fast. But how do you actually trade breakouts the right way? Is there a method to the madness? Are there hidden techniques? Absolutely. And in this video, I'm going to break them down for you. Let's dive right in. Have you ever done this? You set up your support and resistance lines, patiently wait for a breakout, and the second price breaks past resistance, boom! You jump into the trade, pumped and ready to ride the wave. You sit back with some popcorn, eyes glued to the screen, and then bam, the price pulls back. Suddenly, you're down bad, and your portfolio takes a hit. Let's fix that. I'm going to show you a simple trick to avoid falling into that trap again. First off, let's define what a breakout actually is. A breakout happens when the price pushes through a significant support or resistance level that's been tested multiple times. When this happens, price often surges, making that moment a prime entry opportunity. So how do we spot these setups ahead of time? The answer lies in recognizing breakout patterns. You've probably seen these before: wedge, flag, rectangle, triangle, and pennant formations. These patterns are all based on price consolidating between two important levels before eventually breaking out. Here's where most traders mess up. They expect the exact same shape as shown in textbooks. But in real markets, price action rarely looks that clean. What matters isn't the picture-perfect pattern, it's identifying strong support and resistance levels that form the pattern. Honestly, you don't even need to memorize the names of these patterns. What matters is that every single one of them shares the same structure. Price consolidates between two key zones, then breaks out. Let's look at a setup. Price has created multiple bounce points on both support and resistance, forming a rectangular range. So far, so good. But this is where people usually go wrong. They see price break through resistance and immediately enter, thinking it's go time. But it turns out to be a false breakout, and the price reverses hard. That trader just lost money. Here's how we avoid that. You need to understand something called momentum candles. These are large candles with strong bodies, or a series of medium-sized candles all moving in the same direction. These are what we want to see before entering a trade. Let me show you what this looks like. In this example, we set a resistance level based on recent highs and a support level below. We wait for a candle to break resistance. A candle forms and pierces the level, but just barely. Most of its body is still inside the range, not a true momentum candle. We hold off. If another bullish candle had appeared fully above the line, that would have counted. But instead, we get a red candle, a warning sign. And what happens? The breakout fails. We saved ourselves by waiting. Here's another example. Again, we draw our levels and wait. A candle breaks out, but its body is too small. We wait. A second candle forms, still too weak. Finally, a third green candle appears. Now we have confirmation. It's time to enter. So what happens next? Well, there are three possibilities. 1, the price keeps moving up. 2, it pulls back to the resistance line and bounces. 3, it breaks out, then drops back into the range. A fake out. So should you wait for a pullback before entering? Personally, I prefer to enter at the close of the momentum candle. Then I set my stop loss just below the resistance level. This way, if price does pull back and bounce, my stop loss is safe. And if the price shoots up right away, I'm already in the trade. Since we waited for momentum confirmation, chances of a fake out are low. But if it does reverse, the stop loss protects us. Now let's talk about the exit strategy. Breakouts usually come with big moves, so using a simple 1.5 risk-reward ratio might leave profit on the table. That's why I use what I call the two-step take-profit method. Here's how it works. 1, enter the trade once the momentum candle closes. 2, set your stop loss just under resistance. 3, set your first take profit at 1.5 times your risk. 4, once price hits that level, sell half your position, locking in profit. 5, move your stop loss up to that take profit level. Now your worst case scenario is break even. 6, for the second target, use the chandelier exit indicator. To do that, go to TradingView, open the Indicators tab, and search for chandelier stop. Then set the ATR multiplier to 2. This gives you your dynamic exit. When the chandelier changes color, That's your signal to close the remaining half of your trade. Take a look. By only selling half your position at 1.5x profit and letting the other half ride, you catch all that extra upside. If you'd sold everything early, you'd have missed it. Also notice, in this example, price rocketed upward without a pullback. This is why I prefer to enter as soon as the breakout candle closes. Most breakouts won't wait. Let's walk through one final example. You find clear levels for support and resistance. Price consolidates. A candle breaks resistance, but has a small body, so you wait. Another candle forms, still not enough. Then 3 green candles appear. That's our cue. You enter the trade. Set your stop loss below resistance and your first take profit at 1.5x. Once hit, sell half your shares. Adjust your stop loss to break even, then turn on the chandelier stop. Ride the rest of the position until the indicator flips and exit the trade. And just like that, you've learned a smarter way to trade breakouts. All I ask in return? Take 2 seconds to hit that like button. Thanks for tuning in. I'll see you in the next one.